My name is Josh Alexander. I'm a real estate agent in Southern California, Orange County specifically. So if you're familiar with Disneyland, probably about 15 minutes away from there. That's kind of the easiest landmark if you're international to know. But I've been in the business for about 5 years now, and basically I sell residential, buy and sell residential real estate. So there's a couple different ways. I mean, the two major ways I break it down is you have the active way of investing. So that has to do with going out and buying rental properties for either long-term or short-term investments. And then you have the passive. So that's going out and just really kind of buying a piece of the market. So like real estate investment trust. And you can just really have someone else do all the work for you, and you can kind of get part of the profits as well as the appreciation of the home. So in terms of what will be best for you, it just kind of depends on how hands-on you want to be. If you just want to press a button and don't worry about it, that's going to be more of the investment side in terms of, like I said, like the real estate investment trusts. If you want to be more hands-on and kind of know what you're doing and really get more into the actual process of buying and selling, then you have those investment properties. And so in terms of which one would be best for you, it really comes down to two different types of investment properties. So you have the first one, which is long-term investment. And that's what a lot of people think of when you think of an investment property, where you have a renter in the property. They're there for 12 months or longer, and they're paying their monthly rent, and you're keeping the property up, but you're not doing really much besides just making sure your tenant is taken care of. That's the first most common type of one. The second one, which is becoming more and more popular, will be the short-term rentals. So that'd be like the Airbnbs, where people go and stay for the weekend. So those ones, the big advantage for anybody investing in those is those are a lot more if you're looking for cash right now. So it's a better investment if you're looking for cash up front. You want some money in your pocket, because generally speaking, you can usually make more per month in your pocket at the end of the day when you do those short-term rentals, because you're just getting more money. Now, in terms of the long-term rentals, those are really good just more to have in your investment profile, because they're just a constant source of income. So as you have those for longer and longer, you're paying down the mortgage on them if you're buying them with a loan, and then eventually you own them outright. And so every month the tenant's paying you, and instead of going towards your mortgage, at that point, once you pay it off, it just starts going into your pocket. So long-term investors, that's usually what I recommend, is going for a rental property with tenants that are going to be there long-term, and it doesn't require much of anything in terms of just managing the property and make sure the tenant's happy. The short term is great for cash now, but it's a lot more intensive in terms of what you have to do, because you're having 2 or 3 people there per week. So you're constantly in coordination with cleaners, with repair people, bookings, making sure everything's done correctly. And it could be a full-time job in itself. So that's really the disadvantage of those short-term rentals. It's a much more hands-on experience, even though you get the cash now. There was definitely a period of time when they shut all that stuff down. So here, for instance, in Southern California, a lot of the vacation areas, like Big Bear is a big one next to us, those were all shut down. So during a pandemic, they weren't allowing those for almost 2 months. After 2 months, they started loosening them, and now they're allowing them again. But that is something that's kind of a whole new risk factor you have to take into account with everything going on now, is that those things could be affected by future pandemics, or if we have a couple more waves coming of this and it doesn't go away, then it could have some more short-term impacts. So that is definitely something to consider, because before that wasn't really on anybody's radar in terms of risks they have to worry about on there. But now that is something that they're looking at. So you want to make sure that you aren't just putting all your money into there, and if something happens for a month, you're going to go bankrupt. You want to have some cash reserves to be able to get you through a few months if something happens where either a pandemic happens or something in the house breaks where you can't rent it for a month and something major has to be fixed. You want to make sure you always have some cash reserves to be able to pay that mortgage if you're buying it with a loan. If you're paying cash, you have a little bit more flexibility, but if you're buying it with a loan, like a lot of first-time investors will be doing, then you want to make sure you have those reserves set aside so you don't get yourself into trouble.